let's consider the controversial topic of executive pay and think about whether senior leaders are being paid too much. Now, if you look at the following photograph, ask yourself which job is more important. Now, I think the reason why this is a powerful photo is because President Barack Obama is fist bumping the janitor Lawrence Lipscomb, and in doing so demonstrates some degree of equality. Indeed, it's true to say that their moral status as humans is equal. But does that mean their jobs are equal? Seems obvious to me that the job of president is much more important than the job of janitor. And indeed, not all janitors' jobs are the same. Which janitor's job would you say is most important? A janitor at McDonald's or a janitor at Morgan Stanley? Again, we're not talking about the moral status of the individual. We're talking about which job creates more value for society. Don't conflate the value as a human being with how marketable those humans' skills are. Whether we want it to be the case or not, it seems clear that a Morgan Stanley janitor is more important than a McDonald's janitor. As Scott Sumner has argued, in a competitive market, wages should reflect an employee's marginal revenue product. In other words, this is the market value of the work being done by that employee. If firms paid workers less than their worth, then they'd be outbid by rival firms and they wouldn't survive. Do janitors at Morgan Stanley require higher wages than a janitor at McDonald's? Yes, they do require a higher wage. Morgan Stanley is forced to pay more than McDonald's. The reason for this is that the executives there are very rich and the visiting clients are very important. The cost of an overflowing toilet in the men's or ladies' room is much greater in dollar terms, in terms of lost consumption to employees or lost business to unimpressed clients, than it is at a McDonald's restroom. The labour market adjusts such that the value created by employees is compensated through their wage. Now, we know that CEOs are paid much more than the rest of their employees. This data shows us that in the UK in 1998, CEOs were paid 48 times as much as the average employee. As of 2016, this has increased to a 129 times impact. Using data from 1980, where in the US CEOs received 42 times the salary of a typical employee, as of 2016, that had leapt up to 347 times the salary. Both in the UK and the US, there's been a massive increase in the ratio of CEO pay to employee pay. Now, one thing to point out about this is that it's tempting to think that rising inequality is because of these earning differentials within a firm. For example, the fact that CEOs are being paid much more than the janitors within the same organisation. The paper mentioned in the footnote, though, argues that over 2/3 of the increase in income inequality from 1981 to 2013 is because of the dispersion of average earnings between firms. In other words, what this is saying is that because high productivity workers cluster together in high productivity firms, the real sources of inequality are the companies who are successful versus the companies who are less successful, rather than the individual employees within the same organisation. Now, there's a strong case against high executive pay, and I think Martin Wolf has summarised it well in this quote. He argues that the evidence is overwhelming. The huge rise in managerial rewards has had next to nothing to do with corporate performance. He says the incentive schemes that generate these extraordinary rewards are worse than mere rent extraction. They distort incentives by encouraging management to increase leverage, thereby making corporate and overall economic performance riskier, and lower spending on fixed investment and research and development. One aspect is the encouragement to short-termism, namely seeking to raise share prices today rather than the value of the firm over the long term. I think this is a really serious concern, and it's something we need to be very careful about when looking at the data and making a judgment about it. The real issue here is the assumption that I made before about whether we have a competitive labour market. Let's look at the argument in favour of high executive pay. Executives can have a big impact on the expected performance of a corporation. When Steve Jobs died, Apple's value fell by $17.5 billion, which was around 5% of their value. When Steve Ballmer resigned from Microsoft, its value rose by more than $20 billion, which was 8% of their value. Clearly, CEO decisions are incredibly important. They can make or break a firm. Evidence also suggests that CEOs are becoming even more important. We know that executive pay has risen faster than median wages, but also firms are more complex and markets are more globalized now. We can think that they're harder to lead than they were before. This interconnectedness suggests that poor decisions by CEOs are even more catastrophic than they were in the past. Also, as Sam Bowman has argued, performance-related pay implies higher pay since it's placing more risk on the employee, and even if executive pay is too high, it's important to recognise that it's the shareholders who are being taken advantage rather than society as a whole. If you own shares in a large company, it's obviously in your direct interest to ensure that CEOs aren't gaming the system to generate more pay than they're delivering in terms of performance. But as a societal-wide issue, it's not that obvious. Similarly, if we're concerned that, say, over the last 10 years executive pay has risen by 82%, while investors have only seen returns of 1%, there's nothing in itself to worry about. Similar example might be that if over the last 10 years IT spending has increased by 100%, that doesn't mean that it wasn't a bad investment. We shouldn't expect that proportional increases in spending in one activity for a firm is going to deliver increases in total economic value being created. This paper looks at some changes in the market for executive pay over time. As you can see quite clearly, executive pay has increased dramatically since the 1980s. But also, this chart shows that executives are less likely to spend their whole career at the same firm. This is really getting at an important characteristic of the labour market when it comes to executive talent. Companies have become bigger and more complicated to run. The market for CEOs has become more professionalised. It seems that general managerial human capital has become increasingly important. Let's consider Stefan Bancel, which is a really good example of this issue. In July 2022, Robert Wright tweeted the following: "The federal government gave Moderna $2.5 billion to develop a COVID-19 vaccine. Meanwhile, Moderna's CEO just walked away from the company with a $926 million golden parachute. This is what oligarchy looks like." Now let's interrogate this a little bit. The emotional pull of this tweet is the implicit claim that the CEO, Stefan Bancel, received some of that subsidy and that the subsidy was linked to the pay package. Whilst $926 million is clearly a lot of money, it doesn't necessarily come out of that $2.5 billion subsidy. Indeed, it's quite possible that the investment, and indeed Bancel's decisions as CEO, created value. And to the extent to which they created value, then it's not the case that it's one thing or the other. Let's look at Moderna's value creation. Bancel is the second largest shareholder in the company and holds around 8% of the total stock. From January 2020 to July 2022, Moderna's market cap rose from $6 billion to $65 billion, a $59 billion increase. You can see the share price in the graph here. Now, the obvious reason for this was their role in COVID vaccines. Moderna had designed their vaccine by January 13, 2020, that actually manufactured it before the first US death. Some estimates are that the social economic value of COVID vaccines as a whole is around $5 trillion. Clearly, this is one of the greatest accomplishments in human achievement in our lifetimes, is the quick approval and logistical outpour of the COVID vaccine. Bancel's revised golden parachute was based on $922 million worth of stock, a $1.5 million cash severance, and a bonus of $2.5 million. Recognizing how much of that golden parachute was linked to the share price of Moderna is important because that share price fluctuates, it engages in risk, and it's also tying his economic rewards to the value being created by the company that he's run. Just so you know, as of June 2023, Bansal is still CEO and the value of his shares remains subject to market conditions. It could go up, it could go down, but it's going to reflect market sentiment as to the performance that he's done in terms of the outcomes that Moderna experience. Now, a $1.5 million cash severance and a bonus of $2.5 million is obviously very good. But if you're contributing to something that has such high social economic value of $5 trillion, this seems like a relatively small fraction. I think this opens up some interesting points for reflection. What proportion of the social benefit created by Moderna should go to the Moderna shareholders? Presumably not all of it, but clearly some of it, maybe most of it. What proportion of the value created for Moderna shareholders should the CEO get as a bonus? This is a difficult question, and in some industries it will be easier than others to try to attribute value to the decisions being made by CEOs. When we look at these types of market activity, nobody is arguing that market prices and shareholder value is giving us a clear understanding of what's going on. The issue, though, is it's giving us some understanding. Similarly, what proportion of shares should the CEO be allowed to have? Is it a good thing or a bad thing that his outcome and his financial position is so heavily dependent on the success of his organization? Most of us would say we want CEO performance to be tied to company performance, but then if we don't allow CEOs to cash that benefit in when they do have a company that does something remarkable, then it means that we don't really believe that after all. Also, just to come back to that original tweet, if we were to compare this situation to an actual oligarchy, the returns would be discretionary rather than market-based, and we possibly wouldn't even see these figures. When we're looking at these types of golden parachute, they'd just be determined by somebody with political influence behind closed doors. The fact that we can actually understand the current market value of the golden parachute demonstrates how far this is from an oligarchic situation. So just to summarize these points, an oligopoly is not the same thing as an oligarchy. Moderna may have a lot of power in the biotech or pharmaceutical industry. Indeed, there are many situations where industries have a relatively small number of companies that have quite large market power. But that market structure of oligopoly is far different from the political system of oligarchy. Even if Moderna have a lot of power, they're still quite a small company compared to others in that industry, and it's certainly clear that Stefan Bansal himself does not have a lot of power over the US economy. He isn't an oligarch, the US economy isn't an oligarchy. The final point I'd like to make is there's nothing wrong with making a lot of money, provided you've created a lot of value. The main reason why oligarchies are a problem is because financial returns are separated from the economic value being created. Those returns are arbitrary and they're discretionary. My message to CEOs listening to this is very clear. Continue to create value to your organizations and value to society. Create so much value that the teeny tiny percentage that you manage to get for yourself will seem massive.